In startups, as a finance leader, trying to get that balance right between spending and saving can be quite delicate. It can be quite tempting to invest in every piece of shiny new tech and hire experts for every single role, but cost control can actually help the business, particularly in early stages. So the key is really finding that right balance between investing in growth and wasting your money. My name is Alysha Randall. I'm a fractional CFO for Fast Growth Consulting, and I also train new and aspiring CFOs within startups and scale-ups. I wrote a book on this topic, Financial Leadership Fundamentals, How to Become a CFO in a Startup or Scale-Up. So feel free to check that out. Otherwise, click on the subscribe button below. I do a video every Thursdays, and I talk about being a finance leader and supporting your founders and board within a startup or scale up. So if that is interesting to you, then please click on the subscribe button. So today, as I mentioned, okay, it's not the most brilliant, sexiest, interesting topic out there. But unfortunately, if you're spending too much time on fighting fires or fundraising and preparing your budgets, this is something that you can sometimes forget about. I know I certainly have before in my career, particularly when I'm in fundraising mode, and I've been in fundraising mode for about 6 months, and I've forgotten to really look at the costing and making sure that we're spending on the right things. So one of the biggest challenges with startups is their resource constraint. So it's either time, which generally is your headcount as well, and cash, which again is your headcount. So these are both really limited, and it's your resource constraints, cash and time. So because you don't have an abundance of cash and time, you want to be really careful on what you're spending your time and your cash on. So the things that you're spending your cash on, are they the best use of that limited amount of resource? So that's a really big question for you and for your founder. And it is quite easy to forget that and spend your resources on things that potentially you should be. So before you can really control your costs, you have to really understand them. So there's a difference between what's nice to have and what's necessary. And this becomes very clear when funds are limited, or should be quite clear when funds are limited. So sometimes it's as simple as listing out all your current expenses and then classifying them into essential and non-essential. Another way of doing it might be is that if you're doing a worst case scenario model in your budget, which hopefully you are, you have to actually make those decisions already. What can the business survive without, assuming that the revenues are lower? And what does the business have to spend money on in order to survive? So while a payroll system might be indispensable, a high-end coffee machine and break room might be considered a luxury. I mean, that's obviously an extreme example, but it just kind of demonstrates the things that you may be considering. So if the business took a downturn, you need a scenario where you can't get any additional funding and need to break even. What would you keep and what would you remove? So this makes it easier to decide on what your essentials are, and then it needs to be a decision on what is essential and what's not, what's holding on to for whatever reasons and what is not. So the power of quarterly software subscriptions reviews. Now, no doubt your business spends a lot of money on software subscriptions. And while each of them might seem quite insignificant on their own, when you add it all up, there's actually quite a sizable drain on your resources. So that's why conducting quarterly reviews on all of your tech subscriptions, I think, is really important. So the way that we do that with our clients, and we do this with all of our clients, is we make sure that in the chart of accounts, all tech subscriptions go to its own cost code. So we actually have in tech and software and product area of the P&L. Within there is a chart of account called tech subscriptions. If you want to put some of your sales and marketing subscriptions within sales and marketing, your contribution line, and not within overheads, that's fine. But I would highly recommend having a sales and marketing tech subscriptions code and a tech and product subscriptions code separately, so that when it comes to reviewing it, and ideally once a quarter, you don't have to sift through all these transactions to find out what is a tech subscription, what isn't. You just simply download those two chart of accounts, easy as, and run a pivot, basically. So usually someone in the team or myself would sit down with the CTO or whoever is head of tech and product, and then ask, as we go through that, are we actively still using this software? Yes or no. Potentially you may need to go out to the business and find out from them directly. The CTO may not know this. Does it still serve our needs, or are there more cost-effective alternatives available? I know, for example, with the finance tech stack, we are currently looking at a couple of changes for new kids on the block that are cheaper than what's currently available. So it is always worthwhile reviewing if this is the best option to do what you want to do, because tech subscriptions are becoming cheaper and easier. And particularly with AI, this is completely going to change. I mean, there may come a point where we're not having many tech subscriptions at all. We just have AI agents that can do it all. Can certain software services be consolidated for a better price point? Again, with lots of competitors, you may find that one of the tech subscriptions that you have, they've just upgraded and have additional features that you could tap into for the same price and get rid of a couple of the other tech subscriptions. And then finally, are all the users being utilized, or can we cut back on the number of users we're using or paying for? So some software, not all, but some software subscription you're paying per user. So those ones you really want to drill down to see if the number of users we're paying for are actually being utilized. So if you regularly revisit your tech stack, then you can ensure that every pound that you're spending actually genuinely adds value to your startup and isn't just another 20 quid here, 20 quid there, 20 quid there is being wasted. Capitalizing on cashback and negotiation services. So, negotiation is very important during the procurement process. I would encourage that as part of your internal policy, if you're reviewing your suppliers and negotiating on the next tool or the next service, that you always approach multiple suppliers. I've definitely come into startups where they just speak to one person and sign up without having looked at different options. If you're looking at other options, you can definitely negotiate discounts, even if you go with your first one that you approached. We found that in another finance tech stack with equity software, and ones that manage your cap table, because we approached 3 different options. We managed to negotiate quite heavily on the price with at least 2 of them that we were happy with. So there are also companies that specialize in helping businesses reclaim cash or negotiate better deals, especially in areas like tech subscriptions, council rates in the UK, if that's relevant, merchant fees, lots more. So, for example, if you're paying council rates, there's certain firms that can help negotiate reductions or even identify overpayments. Similarly, if you're shouldering hefty merchant fees, there might be room to negotiate, or you could look for alternative providers offering competitive rates. One of my clients, Super Payments, would definitely be something to look at there. There are also more and more cashback services offering a way to get a percentage of your expenditures back. And there's other businesses that we also use that negotiate multiple businesses with the same type of, say with Salesforce, for example, and because they're coming to Salesforce with so many clients, because of the volume, they're able to negotiate a better rate. So it's always worthwhile over time, looking at all these different savings because they can really add up over time. So by being proactive about cost control doesn't necessarily mean you're stifling growth and that every time someone asks to spend something, you're saying no. Instead, it means you're making well-informed decisions to ensure that sustainable growth is there. So in early stages of a startup where every decision can really impact the trajectory, then finding that kind of balance is really beneficial, and arguably it's actually crucial. So by reviewing those outgoings regularly, leveraging negotiation, cashback services, having a clear understanding of what's essential and what isn't, then over the long term, you'll really get a financial benefit from being quite good with that review. Now, if you want to be a CFO within a startup or scale up, then I've got 3-step plan for you that you can get started with right away. Number 1 is to subscribe to this channel so you get weekly recommendations like in this video. Number 2 is to check out the Financial Leadership Fundamentals book that I mentioned. It has very specific steps as to things that you can implement today, because at the end of every chapter, there are actions that you can implement within your role immediately, even if you're not yet in that CFO role. If you're in that finance manager, financial controller role, and you really want to demonstrate your value, this is a great way of doing it. And the third one is to check out our FLF program, where we have monthly Q&A sessions with myself, and we can talk about the challenges that you're currently having in your role. Otherwise, thanks so much for watching, and I'll see you next week. Cheers.